Risk management is crucial when trading options, especially with a strategy involving bull put spreads on SPX and long VIX calls for hedging. Effective risk management protects your capital, maximizes your gains, and minimizes potential losses. Below is a detailed breakdown of the best risk management practices specific to this strategy. Position sizing refers to how much of your capital you allocate to each trade. Proper sizing ensures that no single trade has the potential to cause significant damage to your portfolio. Bull put spreads on SPX, risk per trade, limit the maximum loss per spread to 1 to 2% of your total portfolio. The maximum loss on a bull put spread is the difference between the two strikes, minus the premium received. For example, if you're trading a 50-point wide bull put spread, say selling a put at 4,300 and buying a put at 4,250, your maximum risk per contract is $5,000, which is 50-point spread times 100 minus the premium you receive. If you collect $1,500 in premium, your risk is $3,500. In this case, if you want to risk no more than 2% of a $100,000 portfolio, you would size these sizes position to ensure your maximum loss does not exceed $2,000. That would mean trading a fraction of a spread or limiting the number of contracts. VIX long calls for hedging. Allocate 1 to 2% of your total portfolio to VX calls for the hedge. This should be considered as insurance rather than a profit-generating trade. The VIX call is designed to offset large, sudden market declines that negatively impact the SPX bull put spread. If you're risking $3,500 on a bull put spread, you might want to allocate $1,000 to $2,000 worth of VIX calls to hedge against a market crash. Note that the VIX call won't perfectly hedge your bull put spread losses, but it will provide protection during high volatility environments. Setting stop losses is essential to prevent excessive losses on both legs of your strategy. Since this is a multi-leg trade involving bull put spreads and VIX calls, you should manage each side independently. Bull put spread stop loss. Stop loss at 50 to 60% of the maximum risk. If the spread loses 50 to 60% of its maximum risk, or the SPX drops close to your short put strike, close or roll the position to avoid further losses. For example, if your maximum risk on a bull put spread is $3,500, set your stop loss around $1,750 to $2,100. You would close the trade if your loss reaches this level. VIX call stop loss. Stop loss on time decay. If your VIX call loses more than 50% of its premium, or if market volatility remains low as the expiration approaches, typically within 2 to 3 weeks, close the VIX call position to avoid further losses from time decay. VIX calls can be expensive due to volatility skew, and it's better to cut your losses if the market doesn't show signs of increasing volatility. Adjusting your trades before they hit stop loss levels can help manage risk without needing to close out completely. Rolling can extend the duration of your trade or reduce the risk if the market moves against you. Rolling the bull put spread, roll down and out. If the SPX is approaching your short put strike and you're concerned about a breach, roll the bull put spread to lower strikes and a later expiration to buy yourself more time and distance. For example, if your original bull put spread was selling a 4,250 put spread, you could roll it to a 4,254,200 spread with an expiration further out, like another 30 days. This reduces the immediate risk, but still allows you to stay in the trade. Adjusting the VIX hedge. If the VIX starts spiking and your long VIX calls become profitable, up 50 to 100% or more, consider scaling out of some of the calls to lock in profits while maintaining part of the hedge. You can also roll up to higher strikes to continue the hedge if you expect volatility to persist. For example, if the VIX is trading around 20 and spikes to 30, your VIX 25 calls may be deep in the money. You could roll the 25 calls to 35 strikes to reduce the cost of the hedge, while still maintaining protection. All right, let's talk about monitoring volatility, specifically the VIX and implied volatility rank, or IVR. Volatility levels play a critical role in this strategy. When entering bull put spreads, ensure that the VIX is low, typically below 18 to 20, and implied volatility on the SPX options is also low to moderate. Low volatility generally favors bull put spreads because it allows you to sell puts without significant market fear. Conversely, buy VIX calls when volatility is low, as their cost is cheaper, and the hedge becomes more effective when volatility rises. Now, let's dive into implied volatility rank. Use IVR to decide when to enter or exit SPX bull put spreads. IVR measures the relative level of implied volatility over the past year. If the IVR is in the 20th percentile or lower, it's a good time to sell bull put spreads because the option premiums are lower, and you're less likely to be impacted by sharp volatility spikes. However, if IVR is in the 80th percentile or higher, it's riskier to sell put spreads because implied volatility is already high, and the market could experience large swings. In these scenarios, you might consider adjusting or hedging more aggressively. Use a risk-reward ratio for each trade. Before entering any position, calculate the risk-reward ratio. This ensures that you are only taking trades with favorable reward potential relative to the risk. Bull put spread. Risk-reward. Optimal ratio. Target a risk-reward ratio of 1 to 3 or better, meaning for every $1 of risk, you should aim for $3 in potential reward. Example, if the maximum potential loss on a bull put spread is $3,500, the potential reward, or premium collected, should be at least $1,150, representing a ratio of 1 to 3. This ensures that even if you experience several losses, a few winning trades can more than cover them. VIX call. Hedge risk reward. Since the VIX call is primarily a hedge, it's harder to quantify a traditional risk-reward ratio. However, you should focus on minimizing cost, the premium paid, while ensuring that the potential upside from a VIX spike is significant enough to cover losses from SPX spreads. Example, if you expect a 50-point loss on your SPX spread due to market volatility, you should aim for the VIX call to increase by at least that much to cover it. Diversification within the strategy. Diversify your bull, put spreads, and hedging strategy across different expiration dates and strikes to spread risk. Bull put spread diversification. Spread your trades across different expiration dates, for example, some weekly, some monthly, and some quarterly, to avoid overexposure to any single expiration period. Vary the strike distances of your spreads to reflect different levels of market confidence. For example, if you expect the SPX to be moderately bullish, you can sell slightly out of the money spreads. If you're less confident, sell further out of the money spreads to reduce risk. Hedge diversification. Consider adding alternative hedges, such as out of the money SPX puts, or even inverse ETFs like VXX or UVXY to diversify your volatility protection. This way, if the VIX hedge doesn't perform as expected, you have other instruments in place to help mitigate losses. Tracking performance and reviewing trades. Tracking performance is key to understanding what's working and what's not. Keeping a detailed trade journal helps you refine your strategy and improve risk management. Record every trade. Keep track of your entry and exit points, reasoning behind the trade, the size of the position, and the result. This will help you spot patterns and areas where you may be over or under managing risk. Monthly reviews. At the end of each month, review your performance. Look at metrics like win rate, average profit per trade, and average loss per trade to ensure that you're maintaining a favorable risk-reward ratio. Emotional control and discipline. One of the most overlooked aspects of risk management is emotional discipline. Fear and greed often cause traders to abandon their risk management rules, leading to bigger losses or missed opportunities. Stick to your plan. Don't deviate from your preset stop losses, position sizes, or take profit levels because of short-term market fluctuations. Avoid revenge trading. If you experience a loss, avoid trying to make it back quickly with larger positions. Stick to your strategy.